Thanks very much, Tim, and good afternoon to everyone, and appreciate Share Cafe for hosting me today, and thanks for dialing in. Tim gave a bit of an overview there, so I can certainly skip forward a couple of slides here. But what I want to focus on today is I'll give you a quick overview of who is NAOS. I'll touch on a concept that we firmly believe in, which is investing behind tailwinds, and then I'll try to provide a company at the end which we feel is benefiting from a particular tailwind, which I'll talk about shortly. So as Tim mentioned, we run 3 listed investment companies. We've been doing so since 2013. We run about $400 million, and we're very much focused on that ASX small and micro cap space of the market, I should say. If you skip forward one slide, please. And you can see here that we've got the same investment strategy, which I'll touch on in a second, but this is a visual way to differentiate how we invest across our 3 different LICs. As I said, one investment strategy, but they're purely different from in terms of size of the relative market caps of the companies which we invest in. Please to the next slide. So what is our investment process and belief? So we are very much focused on value, but also long-term growth. We have been perceived as value managers in the past, and that's great from one perspective, but we're certainly looking for businesses that do grow over time and compound capital. We're very concentrated. We don't believe in holding 50, 60, 70 type stocks. We probably hold 20 odd positions across that whole group of $400 million worth of capital. So we'd rather focus where we think we've got the best advantage of an understanding of businesses, and in businesses that we believe can fit our strategy over the longer term. We take a 5-year plus view when we do invest, and you know, just a bit of anecdotal there. We've just sold a company that we've owned since 2013, so we definitely do take a longer term focus when we invest. We don't have any liquidity restraints because we do operate listed investment company in terms of the structures. It allows us to take long-term views, and we're happy to go up the ownership curve and own up to 30+% of some companies. We completely are index agnostic. Yes, we're benchmarked to it, but all the businesses that we hold, many of them aren't actually in the indexes at all. So pure focus in that industrial type space. So we don't do early stage tech, mining, things like that. We're very much focused on what we believe is our circle of competence. We like to invest in businesses where we've got strong alignment with the management. We're very big believers in this. So the biggest I think we've got is a company where the manager, the CEO owns up to 70%. So we're very happy to own alongside who we believe to be good CEOs and founders of a lot of these businesses. We've got a strong ESG focus. That's not just a negative screen, but we do actually provide a positive screen on that as well, and constructive engagement and annual questionnaires with all of our companies. And certainly it's a work in progress, but we do believe we're improving there all the time. And finally, because we do have often such very large positions, and we are substantial shareholders in a lot of the businesses that we own, we have the ability to engage constructively with management teams. And I want to stress this is not activism. So we look at it from a positive lens, in the sense of we might help with capital management initiatives, strategic initiatives, marketing and communication, and a whole host of things like that. And we're certainly doing that more over time. Next slide, please. So the focus I want to talk about here today is the concept of investing behind tailwinds. And I think this is really big for us internally, is you want to be investing in areas where you think there's an environment to create growth over time. There's a quote here from Jeff Pollen, but if we skip forward one slide, and what I want to focus on here is, I think equities, investing in equities, we can all, I suppose, relate, is hard enough, let alone if you're fighting, I suppose, with one hand tied behind your back. So in our opinion, the best way to get risk-adjusted returns over time is investing in areas where you're likely to have market growth. And also with that, I think there's a really big factor you need to consider is short-term and long-term differences between headwinds and also tailwinds. So as an example, at the moment, let's talk about the tourism industry. Clearly, that is facing a short-term headwind with everything to do with COVID. But if you look further out, that possibly creates a pent-up demand cycle that should play out over the medium to longer term. And secondly, it may be a bad example, but if you look at a short-term tailwind which might switch to a headwind, you might look at, say, a coal price spike or something like that, but clearly there are longer-term ramifications for, let's say, that industry as a whole. And I really want to focus here that I think it's all about long-term. And as much as a long-term tailwind can be a benefit to a business, a long-term headwind can be equally as painful, if not more. we've all seen the example of Kodak over time, which was probably the key case of when a business just completely missed a digital transformation moment. So this is very much a focus, and all our businesses, I want to stress, we aren't thematic investors. We build bottom-up research and we focus company specific, but we look to invest in companies which are benefiting over the longer term. And that provides an opportunity for those companies to invest capital in constructive ways, knowing that they've got the confidence of the environment behind them. So if I go to the next slide here, I want to focus on the tailwind in particular. Clearly, everyone knows about the aging population thematic that is underpinning the market today and the whole economy, and will continue to do so over a longer period of time. But if you think about the fact that, yes, we've got the baby boomers who started, our first baby boomer was in 2011, and that is obviously going to continue over time. But if you factor in that the cost this has on the population, not just from a government stimulus cost in that sense, but it's also the lack of revenue that then subsequently drives in the economy as you get more people working through the age where they are typically working into a retirement phase. And I think that's a really key thing, is 1 in 5 at the moment, Australians are approximately over 65, and that is only going to continue. And the compounding effect of that is very significant over time. And if we look at the next slide, housing affordability is clearly a topic that everyone is familiar with. But I think when you pair it with aging population, you're seeing the fact that less home ownership is occurring over time. More people are renting. So therefore, more people don't have the option to necessarily stay in their own homes for a longer period. This creates a situation for the government, which clearly is a macroeconomic factor we all need to consider. If we come to the next slide, I suppose this just further impetus, I should say, to that is the cohorts here. The numbers are small, so forgive me here, but the cohorts of home ownership are clearly decreasing over time. Those in the kind of 70 to 75-year-old bracket now are up the top there, and the younger folks like myself down the bottom. Home ownership is very much a lesser factor these days for a lot of people. If we come to the next slide, clearly, yes, this is a problem and everyone's identified it, but what is the solution? And I don't think there is one solution at all, because it is such a big macroeconomic driver. But if you think about what the government's very focused on, it's aging in place. And because the concept of residential aged care is such a high cost subsidised environment to the government, they want to do everything they can to keep people out of aged care and within their existing communities. Not only does that have material economic benefit, but it clearly has social benefits for the individuals as well, around maintaining independence, connections with existing relationships and families, and obviously familiarity with the existing neighbourhoods that they operate in. So yes, that's great. We've identified how this can be solved to some degree with an aging in place strategy, but where are the ways you can invest in such a thing? And from our point of view, we think the independent seniors living is a way that you can get exposure to this particular tailwind. So if we come to the next slide, I want to touch on a company in focus, which we are substantial shareholders in at NAOS, and that company is Eureka Group. It's got about $140 million market cap, so it is very much a small business, and they are a manager and owner of independent seniors living profiles and villages across the country, predominantly up around the eastern seaboard at the moment, but hopefully more over time. I think it's really key to note, this is not aged care. This is purely a rental agreement with the underlying person who's living in the villages, and it is predominantly government-backed revenue cycles, predominantly from the pension there at 90-odd% of the total group's revenue. They've got about 40 villages at the moment, both owned and managed, and we are of the opinion that there is a very significant upside in terms of the ability to grow that 40 villages over time, not just through existing M&A in a typical structure, but a lot of the sites that they own would have existing land that is undeveloped at the moment. So you might be able to obviously develop that land over time. And secondly, it might be in the sense of buying just basic land off a developer somewhere and then creating your own villages from scratch. At the moment, Eureka Group is just dabbling in the bottom two, and they've been very, very stringent in executing the M&A profile over the last couple of years. And if we come to the next slide here, last one from me in terms of Eureka Group, there are many factors that go into any sort of analysis that we at NAOS do for for a business, but I just thought this was a really interesting chart to show the institutionalizing of particular asset classes over time, in our opinion. And whilst the numbers are small here, I want to highlight, if you look at the childcare there, was approximately a 9.5% capitalization rate, being the income to asset value ratio of those properties over time. You can see the significant drop with the likes of childcare, the likes of storage centres there, and as well as those manufacturing housing estates, which has been on that trajectory over the last couple of years. If you look at independent seniors living, one of these is Eureka Group's portfolio. You can see that has not really kicked in yet. We see no reason to believe that this asset class, with very, very repeatable and government-backed recurring revenues and strong industry tailwinds behind it, should not see some sort of capitalisation compression over time. And whilst this is not necessarily a factor for Eureka Group's wider business in how we necessarily analyse the whole thing, it is certainly a factor which I think is just worth considering. If we come to the next slide, just a little bit more about NAOS. So, as I said, we're 3 listed investment companies, and we put very much a big focus on around the marketing profile of our business. So, should you have interest, you can keep in touch with us through weekly webinars, weekly CEO insights. We do certainly do quarterly webinars and monthly NTAs. If we come to the next slide, and that's just, I talked about it at the start on our ESG profile when we're looking at a lot of these businesses. Eureka Group is a classic example. They're providing social infrastructure. But NAOS itself, we practice what we preach. So we certainly try to do our bit there. And there's a few of the charities that we support down the bottom there. So that is, I believe, everything I had to talk about today. And happy to open up for any sort of Q&A, should there be some. Thanks for listening.
Thanks, Rob. So you're a value investor. Is that why you're industrial focused and kind of like the commodity sector, the resource sector? I mean, that's an industry driven by tailwinds. Is that why you don't focus on that part of the market?
So I think we may be pigeonholed as valued investors, but certainly when we look at any business, we're looking for them to grow over the medium to longer term. And we use the concept of industrials quite broadly. So that does include software businesses. It does include things like marketing agencies that we've had a big position in the past, SME financing businesses. So there's quite a broad scope under that industrials banner that we do invest. And we firmly believe that is our circle of competence. And we like to focus on companies within that that are growing, but also have tailwinds. So that's just how we've ended up over time. That's our circle of competence, and we won't really be deviating from that.
No, understood. And can you talk to, you mentioned a tailwind there with the ageing population. Can you talk to some of the other tailwinds that you're focusing on as well?
Not a problem. Yeah, sure. So just very high level. I think there's a big one clearly around the digitization of everything we do. I think if you look at government and regulated industries, they are very much behind on that adoption curve of technology. So we think that's a big one over time. This is a little bit contrarian, but we're big believers in that tourism rebound. I did touch on that being a short-term headwind, and there's absolutely no denying that. But we think that does certainly translate over time to growth. And I think another one where we've got exposure is in that building and construction cycle. Yes, you've got the issues at the moment around shortages with timber and the like, and steel pricing. But if you look at the backlog of housing approvals to then actually construction over time, we think that's a very pressing one that will play out over the couple of years ahead, as well as the infrastructure, which will, it's a great way to stimulate your way out of I suppose a recession is through infrastructure. And we're certainly seeing that, and we'll continue to see that over time.
Makes sense. And where do you see the risk in the market at the moment?
Oh, look, from a macro point of view, that's a loaded question, and I'm certainly no expert on that, but I do think there is risk in valuation, and I think a lot of the things we see, we do a CEO Insights weekly where we look at transcripts and quotes from all over the world from CEOs and whatnot, and clearly the inflation topic is the one that comes up the most. Inflation, and second to that is obviously the freight and logistics issues. So I think the risk around inflation being not transitory, being actually here to stay, is one that can have massive ramifications across the market.
There's a question here from an investor. There's no minimum amount when they buy your LICs, are there? There's 3 listed vehicles they can buy on market today.
That's exactly right. It's the same as buying a Commonwealth Bank share or that kind of concept. Yep.